Bit different this year. We're going to have a couple people at a time. Is my mic? There we go. My mic went off for just a second. We're going to do it in different segments this time because the people have similarities in their experience. So we're going to bring up two economists first, and we'll talk about the economy and some of the things that are going on. Mark Palim. He's the Director of Economics for Fannie Mae and Strategic Research Group at Fannie Mae. His work focuses on the impact of trends in the financial services sector and the economy in Fannie Mae. Thank you. Right here, there, that's fine. And also, Eric Janszen is here again. He's an economic and financial market analyst. Author, speaker with more than 28 years of executive experience in high technology startup companies, venture capital, finance, and economics, founder and president of iTulip, Inc., and author of The Post-Catastrophe Economy. Eric. Okay. By the way, it's exciting to be the moderator of this because I'm really questioning people that are much brighter than I am, just so you know. And what that does is it puts a challenge because I do a lot of reading because I try to be ready, but it's fun. Just overhearing the conversations at the table was fun to hear, and we're about to direct some of that your way, so that's a lot of fun. Mark, I think I'll start with you. There's a quarterly credit supplement that you guys put out, and just a couple of the categories. How's the sentiment, let's say, in the prices? What are people feeling about the way prices are headed?
Sure. First of all, I wanted to thank you for including me on the panel, and I do have to say for the lawyers back at the office that my views are just my views. That keeps it simple. And I didn't bring my wife because she would say, and I don't even agree with them.
Well, I appreciate it. That means I can ask you some more questions. That's good.
That's right.
So these reports that reveal sentiment, and so one of them being prices, has that been changing in a positive way?
Sure, yeah, that's a very interesting question. You know, as economists, one of the things we'll always puzzle over and have since at least the Great Depression is how do you get a handle on expectations? We know that expectations have a huge impact on markets, right? People make decisions under uncertainty. You do it all the time when you invest and you buy a property or if you're lending. So one of the things we've done is we've started doing consumer surveys again in the last few years. And what we've seen since about November of last year is a real improvement in people's expectations about house prices. And so one of the things we ask people is how much do they expect rents will go up? What do they expect home prices will go up? And we've seen that the part that I think is very encouraging is not only that we've seen this trend month after month, But the amount by which people think prices are going to go up is actually reasonable in terms of it's not a bubble mentality. They're telling us that they think on average it'll be 1.5%. You know, another month it might be 1.25%, it might be 1%. Those are, to me, expectations that create, you know, solid demand.
Yes. And yet it's enough to encourage them to participate?
Well, I think one of the things that's helping drive, you know, increased demand from first-time buyers in particular is how much rents are going up.
Yeah.
And you see it in the data, and you also see it in the expectations. In the same survey, people are telling us they think rents are going to go up about 3.5%. And as I think you alluded to and showed for California, it's true in many markets. It's actually cheaper now to own than to rent.
Does being delinquent change their feeling of what's next for the future?
You know, that is another thing we look at. And delinquent borrowers have remained significantly positive. They're not quite as positive as other lenders, but they're nothing like as different in their consumer attitudes about housing in terms of their desire to want to continue to have home ownership. In terms of their view that housing is a good investment. So that's one thing. If you were coming at it, you know, with just a pure economics background, you'd think, well, they've really been burnt hard. They wouldn't be interested. But they remain very interested in home ownership.
Okay. As an economist, do you feel that we've passed the bottom of the housing market and now we're on an upswing that's sustainable?
Well, we haven't called the bottom. What I do think what we're seeing in the data, and we're seeing it pretty broadly across the country, is the return of a seasonal pattern where we had a really good spring in terms of not only house prices, but also days on market. Many markets are returning back to a very healthy situation in terms of supply and demand. The reason I'm a little hesitant to say that, you know, we're definitely past the bottom goes with the fact that, you know, prices are currently being supported by incredibly low interest rates and the federal government having a huge involvement in supporting credit. So.
Can you just promise to keep them there for a while? I lost my mic again? Okay. You can't promise that?
Fortunately, I can't promise anything.
What would be your expectations on that, though? Do you think that interest rates are likely to remain reasonably where they are for a while?
You know, that is our current view and forecast for the next few years, that mortgage rates will stay around where they are with a little bit of an uptick over time as the economy improves. I mean, the Federal Reserve has been very clear that they will keep interest rates low for as long as they think they need to, and they've backed that up with immense purchases of MBS. So that's currently our forecast.
What were the positives that got us off the bottom to this point?
You know, I think it's a combination of things. One thing is that markets actually work after a while. You know, we had prices came down 30%, and people looked at it and said, you know, at that price, maybe I'll stop renting and I'll buy. You know, we've also had employment is improving. It's not back to where one would want it to be, but there has been some improvement. And I think those two things have helped immensely, along with low interest rates.
Do you feel that some of the improvement, or Mike again, am I sitting on something wrong? It could be. Okay, it's working again. I'll lay it there. Do you feel that the improvement in the market was driven by real forces or mostly by policy decisions, would you say?
Well, we're in a period of unprecedented policy intervention, but I think that when, you know, individuals look at the price of a house and look at interest rates and, you know, take on the commitment to own a home or to buy an investment property, you know, those are real decisions.
When you do research, and what if you came up with a scenario that you go, wow, this is significant, and you told that to Fannie Mae, would they sometimes implement new policies based on now their expectations on their own? In other words, this is definitely moving forward, or maybe in 2005 telling them we got to be very careful, this is dangerous. Who do they listen to, and how quickly does it get the policy?
Sure. You know, we're fortunate in our group, in the economics and strategy group. We have a terrific management team that does listen to a lot of the research we do. It's a battleship-sized organization, right? Our balance sheet is a $3 trillion balance sheet. We're in conservatorship. The conservator is ultimately responsible for guarding taxpayer monies, so things move slowly and judiciously and with care. But I do think at least everybody I've met over the 3 years I've been there is very conscious of trying to make data-driven decisions and trying to make the best decisions they can.
Do you think you could put a good word in for investors to bump that number of loans that are available? You're here. I had to ask.
No, it's a terrific question. And if you spoke to our REO operation in Dallas and the people who run that, they love individual investors. I mean, we disposed of, I think at the height, we probably had about 180,000 homes in inventory. We were taking in maybe 14,000, 15,000 a month, selling that many. And, we get terrific execution from new homeowners and from individual investors. So at least within the company, I think we very much appreciate investors.
All right. Well, I appreciate being appreciated. We would just love, we would love another friend back there saying, you ought to give those guys 20 loans instead of whatever they have. Eric, I'm going to direct some questions to you.
Sure.
One of the things that I really respect about Eric, there's a few things that he's kind of called that you have an appreciation about the process that he must believe in, that it removes emotion away from the decision. So in a stock market that went crazy in the 90s, when you tell your investors that follow you that you would exit like by the end of 1999 or early 2000, that was a nice thing to know. Buying gold at 270 and never selling it. The one that just is amazing is I have a friend that has silver and a lot of it, and I got an email because I signed up for his website, and he just told everybody off, just out of the blue really, because you had the silver from the same, probably the same time frame as the gold. So years into the purchase, I mean, he just sends an email, I'm selling all my silver. So I forwarded that to my friend. I said, Alex, I would take this guy seriously. He's got a pretty good track record of picking tops and bottoms. And my friend said, nah, it's going to 100. And about 3 days later, it was about 30-something. And so but I appreciate the process, okay? Now, what scares me about my respect of your process is you disagree with my real estate conclusions. But, that's kind of why we're here. We're not here to pat me on the back or predict anything. I really want to understand why really well-meaning, educated people come to different conclusions sometimes, okay? So this is one of your quotes. To lay out my model for the rate and duration of the decline, which I've determined to be 10 to 15 years from 2005, depending on the form and extent of government intervention in the market. When did you make that statement first?
2004.
2004, okay. Has the extent of government intervention surprised you?
Yes. I think Mark put it, if anything, you understated it to say it was unprecedented government intervention in the market.
Okay. And you were surprised by very little, but QE3 was one of them.
Well, QE3 was interesting because it was specifically focused on buying mortgage-backed securities. All the other quantitative easing before that was both treasury bonds and mortgage-backed securities. So this was directed specifically at the housing industry.
Okay. And so what will be the effect for the housing industry on that policy?
Well, I think it'll be positive. So what Bernanke has been trying to do, and this is standard economic theory, is reinflate asset prices, financial assets. If you look at household balance sheets, and there's a document that the Fed puts out every quarter called the Fed Flow of Funds, and it measures household worth, measures two things: financial assets and tangible assets. Tangible assets or a small portion of it, it's basically housing value, or 90% of it. The other 10% is like a refrigerator and stuff like that. But the financial assets are stocks and bonds and portfolio assets, and those are back to where they were before the crisis. So QE, in his view, has been successful in reflating those, because standard theory is that if you can increase household net worth, it has a positive wealth effect, and that moves the aggregate demand curve up and improves the economy. So that has been successful insofar as it was, that's what it was intended to do.
Do you mostly agree or disagree with my opening remarks then?
Well, Bruce, I agree with everything you're saying about your market here. I'm no expert on your regional market. I'm more of a macro guy.
Okay.
So my concerns are more macroeconomic. So, in terms of the housing market nationally, if you think about, a housing bubble or any kind of bubble is a process. It's not an event. It takes, a housing bubble in particular, took a long time to unfold. In my view, it started in the mid-1990s. It really took off around 2002 with some extraordinary intervention by the Federal Reserve, which really caused it to take off until it crashed in 2006. So this has been a very long period of time, I would say from 1998 until now, when there hasn't been what I would generally consider to be a market price for real estate in the United States. It's been distorted one way or the other by government intervention. So trying to figure out, for an average person trying to figure out what the price of real estate should be, whether it's here or in Boston or in Ohio, is a little bit like being in a casino for 2 weeks and trying to figure out what time it is.
I just want to mention, I need to know the time that we've been up here. I lost track of that, and I don't want to go too much into this and eliminate other people from having their time. How important is how important is housing to an economic recovery for the U.S.?
Well, we've never had a sustained recovery from a recession without housing recovering first since since the 1960s. That's always been the pattern.
And how subservient is real estate in the United States to things outside of our country? In other words, let's say Europe ends up having a pretty nasty recession again. How does, and by the way, correct me if you think they're not going to have a recession, but if they have a recession, what are the ramifications for not just the United States, but real estate in the United States?
Well, let me get back to the reason why real estate leads recoveries, or has in the past. So, a recession is technically just a period of time when the economy is shrinking, so it has negative GDP growth. And what it creates is what's called an output gap, a gap between potential GDP and the actual GDP. And in all recessions in most of our lifetimes, it's always closed within a relatively short period of time. Even during the very large recessions that we had in the early 1980s, it closed in 1 year, from about 7.5% of GDP to zero in 1 year. A very rapid recovery. The so-called Great Recession produced an output gap of almost about the same amount, about 7.7% of GDP, but it hasn't really closed at all. It's still 7.5. So it stayed parallel. And this gets back to the question of why traditionally real estate has always been regional, prices are regional, and how we knew that we were getting a housing bubble. When I started writing about the bubble in 2002, the signature event was a divergence of housing prices from regional incomes. It's logical that regional home prices should be correlated to regional incomes, because you're going to buy a house within about 30 miles of your commute, and you're going to pay the mortgage you can afford based on your income. And so that's why housing prices tend to be regional. When they diverge, then something is inflating prices beyond what normally incomes would support. So when you tell me that you're seeing prices go up, but employment isn't going up, there's some other factor besides normal market factors driving it. And then that raises the question, will that continue?
Yes.
Right?
I was trying to get that out of Fannie Mae, but my goodness,
think
he wouldn't come up with it.
I wasn't allowed to say anything, right? So the one thing I would add to what was just said is that the other interesting phenomenon you get is large differences across the country based on elasticity of supply, which we're going to choke on that wood. But what does that mean? The ability of builders to build the moment demand picks up. So if you look at the boom and the bust on the coasts and areas where there's geographic limitations and then politically imposed limitations through zoning, the moment incomes start to go up and credit loosens, you see prices start to move up. If you go to Plano, Texas, just to pick one example where there's a lot of land and it's developer friendly, you just don't get the same boom-bust cycle that you get, for example, in Manhattan or San Francisco. And I don't know how the counties here would compare on how difficult it is to add to the supply. That's definitely going to be a factor that's affecting the differences in regional performance.
I think for right now, we'll go ahead and just say thank you, and we'll have you back up here in a little bit. Mark Palim and Eric Janszen, thank you very much.